A slower Fed means smaller gains for stocks. Simple question, maybe a complex answer. Let's ask our panel. Ed Yardeni, he's the president of Yardeni Research. Cameron Dawson, Chief Investment Officer, NewEdge Wealth. Joe Terranova, Chief Market Strategist for Virtus, a CNBC contributor. It's great to have everybody here. Ed, it's good to have you here.
Thank you.
The set in person. It doesn't happen that often, so I'm going to begin with you. I mean, what's the most important thing you're thinking about these days when you look at the market?
Well, look, I think it's always the Fed, right? The Fed is always taking top spot when it comes to thinking about the markets. And we've been thinking that Powell turned way too dovish back at Jackson Hole, and that the 50 basis point cut wasn't really justified, that the economy's resilience doing well. And, you know, it's not mission accomplished yet on inflation. We still have some stickiness in some areas of that area. So I think I'm predicting none and done for the rest of the year.
None and done from the Fed?
Yes.
Wow. I mean, look, Bostic a little bit earlier says he's keeping the door open to skipping a cut
One and done.
in November. But look, let's play.
He's coming in my way.
Yeah, you can't wish for the cards you hoped to have in your hand. You play the cards that are dealt, correct?
Yeah.
So, you know, we got to 50. Market thinks we're going to get a couple more cuts, maybe 25 and 25. So let's play that hand. Mm-hmm. Is that bullish for stocks?
Well, yes, I think it is bullish for stocks. I mean, the fact of the matter is, it wasn't too long ago when we were worrying about the Fed raising interest rates, and then why aren't they lowering interest rates? And now we're kind of saying, okay, what's more, give us more. But look, in my scenario, rates are pretty comfortable where they are relative to the economy. Earnings do fine. And this notion that the interest rate sensitive areas of the markets, the mid caps and the small caps, will make a big comeback. I'm kind of questioning that, because they do need lower interest rates, and I don't know that they're going to get the kind of rate drops that the market is anticipating. So I think what you do is keep playing the S&P 500, and I think it's broadening out to the S&P 493. The Magnificent Seven now becomes the 493.
Okay. Cameron, how do you see it?
So when it comes to small caps, we do think, in agreement with you, Ed, that they don't necessarily deserve the benefit of the doubt. The fact that small caps have big earnings growth expected for 2025 of 32%. But remember that at the start of 2024, estimates for this year were for 25%. Right. They're now negative 7%.
They're not delivering.
They're not delivering. Estimate revisions are coming down. So unless you see a turn in those earnings forecasts, it seems like they'll continue to chop.
And it's been like that for a couple of years now. They've just been kind of in a coma, while the S&P 500 earnings have been doing really well.
Certainly, but we do note that you have seen S&P 500 estimates starting to revise, get a little bit lower for 2025, which is probably one of the reasons why the market has been kind of flat for the last few months and chopping around, simply because you're not seeing those earnings press higher.
Joseph.
I think the market is beginning to, from a strategic perspective, clench up a little bit, and I think it's rightfully so. I agree with Ed. I think it was clearly a sell the news moment for Treasury yields and the Russell, the Fed announcement. We've talked about the fact that you had the low for the 10-year and the 30-year the day before the Fed announcement, and the Russell peaked right when the announcement came out. So I think the market strategically is clenching up and recognizing it wants quality, it wants the Mag 7, it wants the 493, it wants to stay high up in the equity size class. I don't know, and this comes from a lot of conversations that I've had this week with institutional investors, with hedge funds, from being at Morgan Stanley for a day, talking to financial advisors. Everyone's treating the election like, we'll worry about it when it's time to worry about it. No, we're 25 days away, and the election trades. This is the first election that I can remember where no institutional investor saying, I'm putting on this election trade. Everyone's saying we're going to sit back, we're going to wait for the election trades on the other side, and it's starting to get late for that. I think that's going to keep volatility high, and I think that it's time to start thinking about, on the other side, where do you actually want to be allocated? I know it's difficult because everything's within a margin of error, but sooner or later we're going to have that moment of resolution.